The last thing we want to talk about in Chapter 17 is the choice between buying domestic financial assets and foreign financial assets. And so, we said that international trade has increased a lot since, say, 1960. But in a digital age, it's, even easier to buy, foreign stocks, foreign bonds, foreign derivatives. And so, if anything, foreign uh, the financial markets are even more international than the goods and services market. And so it's important to think about those choices, right? Because if you're an investor and you want to get the highest return for your investment, then you not only have to compare, stocks and bonds like we talked about in chapter 14, but you have to compare US stocks with stocks around the world, US bonds with bonds around the world, and you're trying to find that highest return, right? So all of these investors are looking for, the highest return while also trying to balance their risk, right? So looking at risk in the United States versus risk in other countries. So if we think about, this choice, right, we're going to do an example with bonds, but we should think about, stocks and other financial investments as well. The idea is that, okay, well, if I'm a U.S. investor and I'm choosing between holding a 1-year U.S. bond or a 1-year U.K. bond, well, how do I make that choice? Well, I have to compare the returns that I'll get in dollars from the U.S. bond, which we know is just, so if we take $1 and invest it in a U.S. bond, then we're just going to get 1 plus IT. Whereas if we take it and invest in a UK bond, well, UK bonds are sold in pounds, right? And so now we have to worry about the exchange rate, not only the current exchange rate, which is E, but also the expected future exchange rate, which is E with a little E for expectation and time period T plus 1. And we have to think about, well, what's the interest rate that I'm going to get in the UK versus the US? So that is I star. So if we take that dollar and we convert it to pounds, that goes $1. Okay, we get whatever the exchange rate is in pounds. We take that, we buy the bond. So we have ET times 1 plus I star T. That I star is the interest rate in the UK. But at the end of the year, we don't care about pounds because we live in the United States. So we want to convert those pounds that we got from the UK bond back into dollars. Well, how do we do that? Well, now we have to worry about the inverse of the exchange rate. So pounds to dollars instead of dollars to pounds. And that gives us back dollars. And so this is the return we get from the US bond. And this whole complicated thing is the expected return that we get from the UK bond. And so note that not only do we have to worry about the current exchange rate now, but also next year's exchange rate. And that obviously is a future expected value. Even though we know the interest rate on the UK bond right now, we don't know the value of the exchange rate next year. So we can figure this out with a little bit more, so this is basically the same math that was in that slide, but we're just equating these two now, right? So the return you get from the US, that's 1 plus IT, should be equal to the return, the expected return that you get from the UK bond, which is 1 plus I star T times the ratio of today's exchange rate to next year's exchange rate. And this is called uncovered interest parity. So, you can just drop that term when you want to sound, very sophisticated. But the idea is that if everybody expects a higher return in the UK compared to the US, then money is going to go to the UK until the interest rate falls or the exchange rate changes until those returns are equal, right? That's what arbitrage means. And of course, that's a lot of what's going on in the financial markets, in the foreign exchange markets, is people trying to get that higher return, right? Trying to figure out which one is going to be higher. Now, that said, right, we could have transaction costs and we could have risk. So transaction costs, as I said, in a digital age are coming down. Obviously, it was a lot harder if you were a U.S. investor in 1920 to buy a UK bond than it is now, or a UK stock. But there could still be some transaction costs, right? And risk is also going to be an important factor, right? Because the risk in the US could be different than the risk in the UK, which could be different than the risk in Argentina or the risk in Russia. And so you need to take that risk into account as well, right? If investors feel like a bond in one country is riskier, that bond's going to have to pay a higher interest rate because there's a higher chance of default. So, all right, we've got this equation. We're going to solve for it, and we're going to get this nice approximation here where the domestic interest rate has to be equal to the foreign interest rate, I star, minus this sort of percent change in the exchange rate. So we can think of this as the expected percent change in the exchange rate. So if the US interest rate and the UK interest rate are the same, then we can say, okay, well, then this second term must be zero, right? Investors must not expect any change in the exchange rate. However, if they're not the same, then there must be an expected change in the interest rate, right? If the domestic interest rate is higher than the foreign interest rate, then there must be, investors must expect to make up the difference in the expected change in the interest rate and vice versa. So I think, this is important. We'll look in a minute about the, sort of UK and US interest rates. But basically what this is saying is that, if we expect exchange rates to be the same next year as they are this year, then we would expect domestic interest rates to be equal to foreign interest rates, assuming that transaction costs and risk are the same. So if we look at US and UK interest rates, we can see, currently, okay, they're both really low. That's not too surprising, right? They both basically dropped to the zero lower bound after the financial crisis. There have been periods where the UK interest rate has been significantly higher. And so you could say that in those cases, the market was expecting a change in the exchange rates. And as we saw, exchange rates did change significantly over this time period from the UK and the US. Now, it doesn't mean that financial markets are always going to get it right, right? They could expect an appreciation or, a significant appreciation and they only get a small appreciation. They could expect a depreciation and there's an appreciation. So it doesn't mean that the financial markets will always be right because there are other things going on, both in terms of the trade of goods and services, which might change, and also in terms of the foreign exchange market, which might change as well. So, but that is at least what they expect. So this is just sort of the introductory chapter for moving from a closed economy to an open economy. When we have openness in goods market, right, that allows more competition. So there's more competition for goods and services. You can choose to buy an American car, a German car, a Japanese car, a Korean car, maybe soon a Chinese car. That's going to depend a lot on the real exchange rate, right? Holding quality and everything else constant. Openness in financial markets is what allows investors to choose between, domestic assets and foreign assets, whether we're talking stocks or bonds or anything else. And that's going to depend on the relative rates of return, but that's going to depend on the exchange rate. So, when we think about the goods market, we want to think mostly about the real exchange rate. When we think about the financial markets, we want to think mostly about the nominal exchange rates, although we also have to think about changes in the nominal exchange rates as we saw.